Welcome to Corporate Finance Explained, where we break down the essential topics every corporate finance professional needs to know. This series is narrated by AI, created using CFI's expert training materials, and designed to help you stay ahead in the world of finance. Enjoy this week's deep dive.
Okay, so you're listening to the deep dive, and we're really glad you're here.
Yeah, thanks for joining us.
Today's deep dive is going to be all about corporate restructuring.
Yeah.
So you're, if you're listening to this, you're probably a corporate finance professional. You've got maybe, 3 to 10 years of experience.
Right.
You might be, working in FP&A. You're doing, maybe you're a corporate development.
Yeah.
You're the finance business partner, or you're a controller, or maybe even treasury.
Yeah. You're probably deep in the weeds in some of these companies.
And you've been working, you probably encountered this strategic question, like when do you split a company up? And when do you keep it together?
Right. When does it make sense to have everything under one roof? And when do you say, you know what, maybe these pieces would be better off on their own?
Right. And how do you actually figure that out?
Exactly. And that's what we're talking about today. So we're diving deep into, you hear these terms, spinoffs, carve-outs, divestitures.
What do those actually mean?
What do they mean? And more importantly, why do companies do them?
Right.
And what are the implications for, enterprise value, capital allocation, and, the big one, shareholder returns?
And we're going to really try to go, beyond just like you open up the textbook and, these are the definitions.
Yeah.
We're going to really try to get into like why strategically do companies actually do this?
Right.
And we'll look at some real world examples.
Absolutely.
And the finance team is right in the middle of all this.
Out and center.
So we'll talk about that as well.
So I think a good place to start is let's just get right at that fundamental question, right? Why would a company ever want to break itself up?
Yeah, that does seem counterintuitive, right?
It does. You think bigger is better, stronger?
More scale, economies of scale.
Exactly. All those things we learned in, business school. But the reality is that
Yes, sometimes it's just not.
sometimes it's not. And what happens is as these companies grow, they get really complex. They become these big conglomerates with, lots of different moving pieces. And sometimes those pieces, they're not really fitting together all that well.
They're not synergistic.
They're not synergistic.
Yeah.
The incentives might be misaligned. You might have one division that's, high growth and another one that's, more mature and they're kind of, butting heads and,
Right. Or they're competing for resources
Exactly.
or they're in completely different markets.
Completely different markets.
Yeah.
And what happens is you get this thing called the conglomerate discount,
Yeah, I've heard of that.
where the market says, you know what, this company as a whole is actually worth less than the sum of its parts.
Right, because they can't quite figure out what the heck is going on.
Exactly.
Yeah.
There's too much noise, too much complexity. So restructuring then becomes a way to kind of unlock that value that's trapped inside.
Yeah, that's interesting. So let's say you've got a division that's doing really well, but it's inside this bigger company that maybe is not doing as well.
Right.
Or it's just a totally different business.
Yeah.
Like how does spinning that division off actually create value?
So think about it this way, right? You've got this high growth division. It's, killing it, but it's stuck inside this larger, slower moving company, right? It's almost like it's being held back.
Yeah, it's like it can't quite breathe.
Exactly. It can't breathe, right? Its potential is masked. Investors can't really see it clearly.
They don't know how to value it.
They don't know how to value it. And even internally, right? It might not be getting the resources it needs to really thrive.
Yeah, because the parent company is focusing on their own thing.
Exactly. They've got different priorities.
Wow.
So when you separate it, you suddenly shine a spotlight on that division. Investors can now see it clearly, they can value it appropriately, and management can really focus on that specific business.
Yeah, so like what are some of the signals that like a company is thinking about doing this?
Well, one of the biggest ones is just strategic misalignment.
Okay.
Right? They've got this business unit that just doesn't really fit anymore.
Yeah.
With the long-term vision of the company.
They've kind of grown apart.
Exactly.
Yeah.
It's like, you've got this, you started out doing one thing and then you kind of, went in different directions.
And it's time to break up.
And it's time to break up, right?
Yeah.
So that's one big one. Another one is, what we talked about earlier, that the market might actually value that standalone business a lot higher
Yeah, they want pure plays.
They want pure plays. They want to be able to invest in a specific sector or a specific business model.
It's like they don't want to buy the whole grocery store. They just want the milk.
Exactly. They just want the milk, right? So when you've got this complex conglomerate, it's harder for them to understand what each piece is really worth.
Yeah.
But when you separate it out,
They can say, I get it. I know what this is.
this is a software company, this is a consumer products company, whatever it is.
Yeah.
And they're willing to pay a premium for that clarity.
Yeah, focus.
Focus.
Yeah, I like that.
Yeah.
And then also, of course, for public companies, that's all about shareholder value.
It always comes back to that, right?
Yeah.
At the end of the day, if management thinks that by separating these businesses, they can actually create more value for shareholders than by keeping them together, well, that's a pretty compelling argument
Yeah.
to do something.
Especially if you're a CEO and your job is to, maximize shareholder value.
Your mandate.
Right.
So you've got to be looking at these options.
And then there's also the kind of the operational side of it, right?
Yeah, sometimes it's just about simplifying things.
Yeah, you've got these massive companies and, they've got all these different, legal entities and bureaucracy, different, systems and processes.
Right.
And so sometimes it's just like, let's just make it simpler.
Yeah, let's streamline, let's get rid of the redundancies.
Right. And that can also save money too, right?
Absolutely. Efficiency leads to cost savings.
Yeah.
Which is, good for the bottom line.
And then sometimes, you have these companies that have taken on a lot of debt.
Mm-hmm.
And so that they need to kind of, clean up their balance sheet.
They need to deleverage.
Yeah. And so they might say, you know what, we're going to sell off this division that, maybe is not core to what we do, but, someone else might really want it.
Yeah, a strategic buyer.
Yeah. And then they can use that cash to pay down their debt.
And strengthen their financial position.
Right.
So there are a lot of different reasons why companies might choose to restructure.
Yeah, it's not just one size fits all.
Not at all. It's very situation specific.
Okay, well, so we've talked about like the kind of the theoretical reasons, like why would a company want to do this?
Right.
But let's look at some real world examples.
Yeah, let's bring it to life.
Okay, so one that comes to mind is PayPal and eBay.
Ah, yes, the classic spinoff.
Yeah, that was back in 2015.
2015.
And so, obviously they were together for a while.
They were a power couple for a time.
Yeah, so like what was going on there? Why did they decide to split up?
So, PayPal was really taking off, right? E-commerce was exploding. Online payments were becoming, the norm.
It was the future.
It was the future, and PayPal was right at the forefront of that.
Yeah.
But, they were kind of tied to eBay's marketplace business, right?
Which was a little bit more old school.
A little bit more, traditional.
Yeah.
And so some people argued that, PayPal wasn't really getting the attention it deserved. It wasn't getting the investment, the strategic focus that it needed to really, become what it could become.
Yeah, because eBay was, focused on their own thing.
Exactly.
Right.
And, sometimes you have these situations where you've got a really high growth, disruptive business unit, and it's kind of trapped inside this, more established parent company.
Right. And the parent company might not even understand it.
They might not even fully get it.
Yeah.
And so it's like, the kid who's, ready to go to college, but they're still living at home with their parents.
Right.
And the parents are like, no, you gotta stay here and finish high school.
Yeah. But they're ready.
But they're ready to go.
Yeah.
So that's kind of what was happening with PayPal and eBay.
So then what happened? So they split up, and then what?
So they split up, and, the results speak for themselves, right?
Yeah.
PayPal took off.
It was huge.
It became this, dominant force in fintech.
Yeah. It's like almost hard to remember a time when they weren't like a major player.
Right. Exactly.
Yeah.
And, eBay, they were able to kind of streamline their operations.
Yeah, they focused on their core business.
They focused on what they were good at.
Right.
And, investors loved it.
They did. They rewarded them for it.
Yeah. PayPal's valuation went through the roof.
Yeah, that's a great example.
Well, it really shows you how, separating a high potential business unit can really unleash its growth.
Yeah, focus.
Focus is key.
Okay, so let's look at another one. Dell and VMware.
Okay. Yeah, that was an interesting one.
So that was 2021. So that's a little more recent.
More recent, yeah.
And so VMware, the like the cloud software, the leader.
Yeah, infrastructure software.
Infrastructure, yeah.
Virtualization, all that stuff.
Yeah, so why did Dell decide to spin them off?
Well, so in this case, it was a little bit different, right? VMware was doing well,
Yeah.
but for Dell, it was also about, they had done a lot of acquisitions over the years. They had a pretty complex capital structure.
A lot of debt.
They had a lot of debt. And so they were looking for ways to kind of simplify things.
Yeah, clean up the balance sheet.
Clean up the balance sheet,
Yeah.
reduce their debt burden.
Yeah.
And so spinning off VMware allowed them to do that.
So they got some cash from that.
They gave some cash. They were able to, kind of streamline their financials.
Right.
And it actually made them a more attractive investment for other investors.
So they got better credit rating.
Yeah, they improved their credit profile. And, for VMware, it allowed them to kind of, operate more independently.
Yeah, focus on their own thing.
Focus on their own thing in this, really competitive cloud market.
Right.
So it was a win-win.
Yeah, everybody was happy.
In this case, yeah.
Okay, so we've seen spin-offs. Let's look at another example. Johnson & Johnson.
J&J.
J&J, yeah. So they spun off their consumer health division.
Right.
And they called it Kenvue.
Kenvue, yeah.
And this was just last year, 2023.
Very recent.
So what was the thinking behind that?
So, J&J, they're this massive company, right? They've got pharmaceuticals, they've got medical devices, and then they had this consumer health division.
Which is like Band-Aids and,
Yeah, Tylenol,
Yeah.
all the over-the-counter stuff.
Yeah.
And so the thinking was that, these are actually pretty different businesses, right?
Yeah.
They have different growth profiles. They have different research and development needs. They have different regulatory environments.
Yeah.
And so by separating them out,
Mm-hmm.
J&J could really focus on, the pharma and the medical devices.
Which are more their core business.
Which are, kind of their bread and butter.
Right.
And Kenvue could, really go after the consumer health market.
Right.
With a dedicated strategy.
And that consumer health market is huge.
It's massive.
Yeah.
So it made sense to kind of let them, run free.
Yeah.
And focus on what they do best.
So it seems like, in all these cases, like spinoffs have worked out pretty well.
Yeah, for the most part.
But it's not always a slam dunk, right?
It's not always a guarantee.
Yeah. So is there an example where like maybe it didn't go so well?
Well, one that comes to mind is AT&T and Warner Media.
Yeah.
So this was back in 2022.
Okay.
And this is actually an interesting one because it was kind of the reverse of a spinoff.
Right. It's like they got together and then they broke up.
Exactly. So AT&T, they had acquired Time Warner a few years earlier.
Right.
With this big idea that they were going to create this, telecom and media powerhouse.
Yeah, it's going to be like it's vertically integrated.
They were going to own the pipes and the content. It was going to be amazing.
Yeah.
But it turned out that, integrating these two massive companies with very different cultures was really, really hard.
Yeah, telco and media are like two totally different worlds.
Yeah.
Yeah.
So the synergies that they had hoped for, they just didn't really materialize.
It was a lot harder than they thought.
A lot harder. And, sometimes that happens, right?
Yeah, you don't know until you try it.
You don't know until you try it.
Yeah.
And so in this case, they realized that it was actually destroying value to keep these two businesses together.
So it was better to break up.
It was better to break up, so they spun off Warner Media.
And it merged with Discovery.
And then they merged with Discovery.
Right.
And, AT&T went back to focusing on, their core business wireless broadband.
Yeah, back to their roots.
Back to their roots. So it was, it was an expensive lesson.
Yeah.
But it was a lesson learned.
Right. And it also shows that, like, sometimes, bigger isn't always better.
Sometimes it's not.
Sometimes focus is really important.
Yeah.
Okay, so that's a great example. What about GE?
GE, the granddaddy of conglomerates.
Yeah, they're breaking up too, right?
They are. It's a multi-year plan.
It's a big one.
It's a big one. They're breaking up into 3 different companies.
Oh.
GE Healthcare, GE Aerospace, and GE Vernova, which is going to be focused on energy.
So they're basically undoing like 100 years of,
Yeah, 100 years of history.
mergers and acquisitions.
Exactly. They're going back to their, their more focused roots.
Yeah.
And the idea is that, these businesses, they'll be more agile. They'll be able to respond to, market changes more quickly.
Yeah, they won't be bogged down by the bureaucracy
Exactly.
of this massive conglomerate.
Right.
Right. And it'll be easy for investors to understand them.
Yeah, transparency is key, right?
Yeah.
And so when you've got these, separate businesses that are clearly defined, investors can say, okay, I get it.
Yeah.
I know what this company does. I know how to value it.
Right. And they're more willing to invest.
They're more willing to invest and they're willing to pay a higher price.
Yeah. So that's a really interesting one. Um, so we've seen a lot of examples of companies breaking up. But what about a company that's decided not to break up,
Okay. Yeah, that's a good point.
even though maybe some people think they should?
Right.
So what about Meta?
Meta, yeah, formerly Facebook.
Yeah, so they've got this, Reality Labs division,
Right. All the VR, AR stuff.
the metaverse.
The metaverse, yeah.
So that's been losing a lot of money.
It has been a big investment.
Yeah, and some people are saying, like, why don't you just spin that off?
Yeah, cut your losses and move on.
Yeah, but they haven't.
They haven't.
So why is that?
So this is an interesting case because it shows you that, the decision to restructure is not always just about the numbers,
Yeah.
right? It's also about, the long-term vision of the company.
Yeah, what do they really believe in?
Exactly. So Mark Zuckerberg, he's really committed to this idea of the metaverse.
He thinks it's the future.
He thinks it's the future,
Yeah.
and he believes that, Reality Labs is a key part of that.
Right.
And so even though it's losing money right now, he's willing to kind of, ride it out.
He's playing the long game.
He's playing the long game.
Yeah.
He's betting that, eventually it's going to pay off.
Yeah, and he's got the, the resources to do that.
He does. He's got deep pocket.
Yeah. So that's a really interesting example of like, sometimes companies, they're going to hold on to something, even if it's not, making money right now,
Right.
because they believe in it.
They believe in the long-term potential.
Right.
So it's not always just about, short-term profits.
Yeah.
Sometimes it's about, the bigger picture.
Yeah. Okay. So we've talked about a lot of examples.
We have.
But let's just like define some terms here.
Okay, let's clarify some things.
Yeah, because we've been talking about spin-offs and carve-outs and divestitures.
Yeah, what do those actually mean?
Yeah. So let's start with spin-off. Like we've been using that term a lot.
Yeah.
What exactly is a spin-off?
So a spin-off is when a company takes a subsidiary and they basically give the shares of that subsidiary to their existing shareholders.
So they're just like giving them away.
They're giving them away.
Yeah.
And they create a brand new independent company
Okay.
that's now publicly traded.
Yeah. So the shareholders, they end up with two different stocks.
They do. They've got their original stock in the parent company.
Right.
And now they've got stock in this new spin-off company.
Okay. And so is that different from a carve-out?
Yes, a carve-out is a little bit different.
Okay.
So in a carve-out, the parent company, they're still selling a portion of their subsidiary, but they're typically doing it through an IPO.
Okay, so they're going public with it.
They're going public with it.
But they're not giving away all the shares.
They're not giving away all the shares. They're usually keeping a controlling stake.
So they still have control.
They still have control.
Okay.
And the money that they raise from the IPO, that goes to the parent company.
Okay.
So it's a way to kind of, raise some capital.
Yeah, without giving up complete control.
Without giving up complete control.
Yeah.
So it's a bit of a hybrid approach.
Okay, and then what about divestiture?
So divestiture is the simplest one.
Okay.
It's just a straight up sale.
Right.
They're selling the entire business unit
To someone else?
to another company.
Like-
Could be a competitor, could be a private equity firm.
Right.
Whoever wants to buy it.
And they're out.
And they're out. They're done with that business.
Okay.
So it's a way to kind of, raise capital, obviously.
Yeah.
But it's also a way to kind of, streamline their operations,
That's not
focus on their core businesses.
Get rid of the distractions.
Exactly.
Yeah. Okay, so those are the three main types.
Yeah, those are the big ones.
So we've talked about like the strategic reasons for doing all this.
Right.
But like what about for, someone who's listening to this,
Yeah.
who's like in the corporate finance world?
What does it mean for you?
Yeah, like what's their role in all of this?
Right, because this isn't just, some theoretical exercise.
Yeah.
This is stuff that you're going to be dealing with in your day-to-day job.
Yeah, so like let's say you're in FP&A or corporate development or treasury.
Yeah.
Like what are some of the things that you might be doing?
So one of the biggest things is you're going to be doing a lot of analysis. Right, when a company is thinking about restructuring, you're going to be the ones who are, crunching the numbers,
Yeah.
figuring out, okay, how do we actually separate these businesses?
Right.
How do we allocate the assets, the liabilities, the revenues, the expenses?
It gets complicated.
It gets really complicated.
Yep.
So you need people who are really good with accounting, really good with financial modeling to kind of untangle all of that.
And then you've got to figure out, like, what's it going to look like in the future?
Exactly right. You're not just looking at the past. You're trying to project what's going to happen to these businesses once they're separated. So you're building these really complex models. You're forecasting growth rates, profitability, cash flows. And there's a lot of uncertainty there, right?
There is.
You're trying to figure out, okay, if we spin off this division, is it going to grow faster? Is it going to be more profitable?
It's going to be able to stand on its own 2 feet.
Exactly. So it's a really challenging, but also really interesting part of the job. And then you've also got to think about the debt. Right? If a company has a lot of debt, how do you allocate that debt between the different entities?
Who gets what?
Who gets what? And what does that mean for their credit ratings?
Because that's going to affect their cost of capital.
Absolutely. It affects their ability to borrow money in the future. So you're going to be working with, bankers and lenders to figure out the best way to structure all of that.
And then you've got to be able to explain all this to investors.
Communication is key. You got to be able to tell the story. Why are we doing this? What are the benefits?
What's the value proposition?
What's the value proposition? How is this going to create value for shareholders?
And how's it going to affect, their earnings per share?
Exactly. All those things. So you got to be able to, communicate clearly and concisely.
And be persuasive.
And be persuasive. So your role in corporate finance during a restructuring, it's really important. It's not just about crunching numbers.
It's strategic.
It's strategic. It's about understanding the big picture. And it's about being able to communicate effectively. So it's a really exciting area to be in.
Okay, so for our listeners, they're listening to this. They're like, okay, this is all very interesting. But like, what are the key takeaways?
What should they remember from this? So I think the biggest takeaway is that spinoffs, carve-outs, divestitures. These are all really powerful tools that companies can use.
To create value.
To create value, to improve their focus. To simplify their operations. And ultimately to make their shareholders happy. So if you're in corporate finance, you need to understand how these things work. You need to be able to analyze them. You need to be able to model them. And you need to be able to communicate about them. And you might actually be involved in doing them.
Exactly. You might be the one who's putting together the presentation for the board. Or you might be the one who's, building the financial model. So it's really important to have this knowledge.
And as you get more senior, you might actually be the one making the decisions.
Exactly. You might be the CFO who's saying, you know what, we need to spin off this division. Or we need to divest this business unit. So the more you understand about these transactions, the better equipped you'll be to make those kinds of decisions.
And also, even if you're not the one making the decisions, you'll be able to understand what's going on.
You'll be able to see the strategy behind it. You'll be able to analyze the financials. And you'll be able to say, you know what, this makes sense or this doesn't make sense. So it's really a valuable skill set to have.
Okay, so to wrap things up, corporate restructuring, it's a big topic.
But hopefully we've given you a good overview.
A good starting point.
And kind of like the key things to think about.
The key considerations?
So now we're going to leave you with a question.
Okay. Hit them with a question.
Think about your own company or a company that you follow. Are there any divisions or business units that you think might actually be more valuable if they were on their own?
If they were spun off or carved out? Is there something that's kind of hidden inside this bigger company? That could really shine if it was given its own spotlight.
And what are the financial and strategic factors that you would need to consider?
How would you analyze that?
To figure that out.
Exactly.
So that's something to think about.
Something to ponder.
And, you're all, smart corporate finance professionals.
You're the experts.
So you can figure this out.
You got this.
And we hope that, this deep dive has given you some of the tools and the knowledge to kind of, tackle these kinds of questions.
To think critically about these issues.
So thanks for listening.
Thanks for joining us.
And we'll see you next time.
Thanks for listening to Corporate Finance Explained. If you found this episode valuable, be sure to check out more episodes and explore CFI's highly rated courses at corporatefinanceinstitute.com. Don't forget to subscribe for more deep dives into essential finance topics. See you next time.